Welcome everybody to our webinar today. I apologize for the delay. We had some technical difficulties we had to address. I welcome you to our webinar today, Diversification and International Investment in Uncertain Times. This is the second part of our webinar series in partnership with UBS. First part aired a couple weeks ago, focusing on strategies, overall strategies. Now we're kind of drilling into some country-specific strategies with focus this time on Europe. My name is Joe Haehner. I'm heading the Foreign Direct Investment Practice for Bekaert here in the United States, and I'm very pleased and excited to have my friends here with me again from UBS, Jakob, Christian, and Marcel. Jakob is joining us from the US. He's representing UBS here in the United States, and Christian and Marcel are both dialing in here from Switzerland. A couple of housekeeping items before we dive into the topics. If you have questions, please either send it to us by email, or you can put it in the chat box. We're gonna compile all the questions and get back to you guys individually. If you have technical problems, please also put it in the chat box, and our team in behind the scenes is gonna try to address it with you as good as they can. With that being said, let's jump into the agenda. What do we want to cover today? Like I said, a couple of weeks ago, we had part one of our series where we focused on international investment strategies per se, and now we're gonna drilling into a couple more country-specific topics. So Christian and Marcel are covering Europe, and specifically Switzerland, Germany, and United Kingdom, and kind of shed some light on the Brexit and how that kind of plays into the equation. And we wanna close with some remarks what we see in the marketplace right now with our clients and customers. We estimate the webinar will take probably between 30 and 45 minutes. Why did we come up with the webinar? Why did we think about having a three-part series of webinars dealing with risk and risk mitigation? Specifically, Jakob and I, we are working closely on client engagements here in the United States, and we received an increased amount of questions, initially triggered by COVID-19 and the coronavirus situation, on how to mitigate risk and address risk going forward. And working with the team in Switzerland, investing outside the United States is one tool to diversify and mitigate risk. So we said, based on the request we received, let's set up a webinar series to address these topics and provide some guidance what the market is doing, and what we see in the marketplace and potential developments. So based on that, let's hand it over to Christian, who is taking us through the details.
Yeah, Joe, thank you very much for the introduction, and hello everybody. Also warm welcome from here, Zurich, Switzerland. First, I would like to shortly introduce UBS Swiss Financial Advisors to you. On the next slide, we have kind of a summary, who we are, what we are doing, and why clients work with us. I mean, in a simple way, we are a US SEC registered investment advisor based here in Zurich. So we are regulated by the US SEC, but also by the Swiss FINMA as a securities broker. So we have a dual kind of audit, meaning that we definitely do everything in a fully US tax compliant way. We have been set up in 2005 specifically for helping US clients to invest internationally, to help them to get access to all international exchanges and to a multi-currency platform. So you can see us like an investment advising boutique within UBS, approximately 70 employees. And definitely one of the main value propositions is that we are based in Switzerland. As for sure, most of you know, Switzerland is a country that has a lot of stability from an economic and political point of view, is doing also, I have to say, pretty well during this COVID-19 crisis. Historically, a country with a very high GDP per capita and a lot of history in doing what we do, managing assets, wealth management, private banking. So we think we have a very good talent pool here in Switzerland, very good infrastructure when it's about helping US clients to invest internationally. On the right side, it's really the four main reasons why US clients, US taxpayers want to work with us. It's for sure, first of all, the expertise we bring to the table. We are sitting here in the middle of Europe. So when we invest in the European markets, in the Swiss market, we don't only go for the well-known blue chips. We dig a little bit lower and invest also in small and mid caps that are maybe not that well known yet in the US. So we bring to the table a different perspective. I always say, compare it a little bit with The Economist. It's the same news, but a different perspective. So clients are interested to hear what is the Swiss perspective, what's going on in the world. Second, what I already mentioned, we give access to a multi-currency platform. As we know, in the US, most of the banks still mainly invest in US dollar denominated investments, but we have access to all currencies globally. So it's about getting exposure to these underlying risk currencies. Then for sure, it's about the geographical diversification. As I mentioned already, we have access to all international equity exchanges, not only here in Europe, but also in emerging markets and in Asia Pacific. So that is really the main ingredient to start working with us. And the last one is for sure also in these times of uncertainties, especially in the US on the political side, but also on the economical side, is having assets in a different jurisdiction. So the assets we manage here in Zurich are booked in the jurisdiction of Switzerland. So we can maybe then go on with the next slide.
Maybe let me add to this, Christian, real quick. Why we enjoy working with you guys is really from a tax compliance perspective, the ability to receive documents in a way and in a fashion and timely, so that it can be processed for our clients in the right way, so that there is no delay or any concerns around the US specific tax documentation.
Absolutely. I mean, UBS Swiss Financial Advisors has been set up in 2005, already under a fully US tax compliant way. So we have really worked on our infrastructure over these years and can really provide our clients with a state-of-the-art 1099 report, very detailed, the necessary FBAR reports. So really all the tax information clients need to file the taxes in April normally, during normal times. And we normally send out all this information beginning of February. So the respective CPAs have plenty of time to file the taxes in time. And in the end, it's really like working with an investment advisor in the US, just that we are based here in Zurich. But this is really well taken care every year. Yeah.
And then one more thing from my side before we get into the nitty-gritty things, just wanted to add, SFA is completely separate. It's a own entity of UBS. So we here in the US are separate and don't see the part which is in Switzerland. However, we are working as for SFA as an extended arm and helping them out. So if there's any need to get more information and meet in person during this difficult times, as right now as the travel is not as great, we are here to help at any time. Go ahead. Sorry.
Great.
Sure. Okay, in the next part, we would definitely elaborate why it makes sense, in our view, to exactly integrate international investments to your overall portfolio strategy, and what really brings advantages when looking at other markets. Next slide, please. Historically, that's a very nice overview how the world has changed in the last 20 years when it's about GDP contribution global. In 2000, we know the US and also Europe were still the main contributors. They're still also very large contributors these days. But obviously, this shows you clearly that already now, we're not in 2025, more than 80% of all investment opportunities in the liquid markets are outside of the US. What is kind of the most clear sign of this is how China did the last 20 years. In 2000, only 7% of global GDP, and today already around 20%. So there you see you have really these three main markets, I would say now globally. It's Europe, it's China, together with Asia Pacific, and it's the US. So we think this development will continue. And for that reason, every international investor, every investor in the US should look at this and get to know more about European markets. And that's what we always try, how to educate our clients. Yeah. Next slide. Another interesting slide, more about the short-term development. When investing internationally, it's not only about the underlying investments, it's also about the currency exposure. As we know in the US, what banks normally can offer is mutual funds covering Europe, but they are normally denominated in US dollar. You can also buy some ADRs. This is kind of a structured product where you get also exposure to international stocks, but also these instruments are denominated in US dollar. So you don't really participate in the underlying risk currency. And in our view, it makes sense in the long run to not only invest internationally in the underlying investments, also to get exposure to the underlying risk currencies. So this graph shows the trade-weighted US dollar index. So it's kind of comparing the US dollar against the basket of other major international currencies like the euro, Swiss franc, the sterling, Singapore dollar, and the Chinese yuan. We have seen now that's kind of 5 years back, always some volatility. In a very short run, we know forecasting currency pairs is very difficult, but it gives you a kind of a hint in what phase we are potentially now. Since the start of COVID-19 in February, March, we have seen quite a sharp, fast depreciation of the US dollar. And we expect in the mid to long run that this trend will continue. There is good possible that we see now some consolidation, also because some investors move back assets to the US, maybe take profit in international markets and bring it back. So we could see some consolidation, but in general, our forecast is we will see a continued weaker US dollar, not against the specific currency, against the basket of currency. So we always recommend investing in different currencies, in different underlying markets, not only on one currency. And when you see what happened already in this short period of 5 years in 2017, where the US dollar had already a phase of weakness, even from the level we are right now today, you could still see some depreciation of 5 to 10%. And we always have to remember when you invest internationally, it's not only the underlying investments that contribute to your performance, is also potential gain on the currencies. In the next section, we would like to talk a little bit more detailed about some specific markets in Europe, specifically Switzerland, Germany, and the United Kingdom. We have chosen these 3 markets because we believe they are well established. They have multiple companies that have an established business model globally. So when considering to start investing internationally the first time, it's maybe a good approach to do it first in a more conservative way, meaning all these markets have anyway a lot of exposure globally. So when you invest in a Siemens company like in Germany, they have global operations, you indirectly get exposure globally, but you hold a company that is headquartered in Germany and has a very established business model. So for that reason, we chose these 3 markets today. As Joe already mentioned, in the next session, we will then also look at the Asian markets directly.
So, Christian, a quick question, and I know we talked about this briefly before we jump into this, regarding Brexit. So we know that the United Kingdom is not part of the technically not part of the European Union anymore since end of January, and by the end of 2021, if there's no contract or no new contracts in place with the EU, there will be basically all the existing contracts about the trade and the financial transactions and personal movements within the remaining European Union and the United Kingdom there will be no regulations for this anymore. And we still thought that this is great to have the United Kingdom in there because they are still an established financial market. Is that correct?
Absolutely, that's correct. I mean, it will be the case that London will still be a major financial hub going forward. So still a lot of transactions are happening there when it's about financial markets. And in general, also when we look at the main UK index at the exchange, it consists of companies that have normally a global business model, meaning there you have definitely to separate the domestic focused companies and more international companies. And it's always, I mean, there are always opportunities out there. It's a general market development, but then you also have a bottom-up approach where you can pick some companies where we see really a good value in the long run. So in the end, it's important to apply active management these days with all these uncertainties. Whereas we know the last 10 years, we had kind of only upside movements in the market, so you could buy an ETF and perform as good as active managers. But in these times, we believe for specific markets like the UK, it's very important to pick the right stocks and to approach an active way, choosing your allocation.
Great.
On the next slide, I would start with Switzerland, as we are based here in Switzerland. It's well known that Switzerland is well established with international companies, but it's not only chocolates, cheese, and mountains we are well known for. It's also for some big pharma firms and some big banks that are maybe best known in the US. But already on this list of the largest companies by turnover, you maybe see some names you never heard about before. It's not only big pharma and banks, it's also construction, transportation, even commodity trading. So obviously a lot of these companies were founded in Switzerland, but some of them, they also moved their headquarters to Switzerland because of the economic and political environment. So it's a very predictable country where things are not changed overnight like in other parts of the world. So that is also a reason it attracts a lot of international companies that maybe were founded somewhere else, but now have their headquarters in Switzerland. Besides these major companies, I also wanted to mention some smaller companies that are maybe not by turnover large, but that are also playing a leading part in their sector globally. First one is Logitech, that is maybe best known now during COVID-19 because everybody's working from home. So it's really one of the global market leaders about technology hardware. So they produce keyboards, mice, and other parts around your laptop you're using on a daily basis these days. So Logitech is a Swiss company headquartered close to Lausanne, for sure also operations in the US, but that's one stock I already wanted to mention. The second one is Givaudan. It's really market leader globally in space of flavors and fragrances. So a lot of perfumes you buy these days, Givaudan is behind it. I mean, they kind of put the ingredients together that you have the smell of your perfume, and they're also doing extremely well. Even they're based here in Switzerland. We have to be aware Switzerland is a high cost country. Salaries are high, social pension fund contributions are high. So you have to be extremely competitive that you can operate globally and still be a market leader. So this gives you an impression that Switzerland has the environment politically, economically, that these companies can attract a lot of good talents over years of good performance, as we have also seen before when it's about GDP per capita. In the next slide, it's again a little bit a longer term view back when it's about GDP growth. Switzerland on top, a very steady path upwards. For sure, shortly behind is the US, Germany, and the UK. So this gives you all an impression also why we are choosing these markets, where you compare it with France and Italy that maybe didn't do that well. So the European Union or the European area is really still diverse, very diverse. You have countries in the south that are not doing that well since they joined, and you have countries like Germany that they are really the main drivers when it's about performance of the European markets. So Switzerland for sure had also some dips during the financial crisis, but you see it's to a much lesser extent than other countries, and recovered much faster. So that's also a kind of a clear sign that the Swiss market, Swiss companies are able normally to adapt very fast to new environments. And we have to say also during this COVID-19 crisis so far, the economic impact has been very well controlled. Also have to say that the government is doing a good job. So again, that's during times of crisis, countries can really prove how well they are established. A next slide is also more on the macro side. It's a very important topic right now because we know all these numbers will spike up, obviously, due to COVID-19. Governments have to put a lot of money into the markets from a monetary and fiscal point of view to support the economy and to have a social safety net for many workers in different industries, that they stay in their job, and that is for sure something what also is important to when we talk about mitigating risks. We all know the US has a different social system than many European countries. But here the long run also shows you clearly Switzerland was able to manage very well its government debt to GDP ratio. That's what we see here. Switzerland these days is around 40%, so a very low number. Germany was even able to reduce its government debt to GDP ratio since the financial crisis, and the US obviously went up and will again have the potentially the highest spike now when we look at this graph in a couple of months. So again, also here, these are really macro facts, fundamentals that normally are also good argument how strong an underlying economy is and how strong a currency should be valued. Meaning, as a higher debt you have, at one point you have to consider to reduce it over the next generations, and you can either do that with a high inflation or with a depreciating currency. So it's always a balance act. I mean, we have seen in the past different approaches, but for sure that's one of the arguments we see potentially US dollar depreciating over the next years. On the next slide, it's then really about performance again of liquid markets, of main indices. So here it's important to understand these numbers are denominated in US dollar, meaning what did these markets do in the last 20 years compared to other markets, and Switzerland by far best performance. This is due to the underlying market, but also by quite some extent to the appreciating currency. So out of this 280, it's around 60%, 65% the currency appreciated against the US dollar. So this gives you again a hint. It's not only underlying investments you have to choose and pick the right ones. It's also to have exposure to foreign currencies. So here we really think it's important to be diversified over different markets. I also have to argue also emerging markets we will cover next time did pretty well, and also there we could see further developments over the next decade because these markets will be exactly in focus when it's about global growth. So now I would like to... Sorry?
Did you mention the index? Did you define that? So maybe not everybody will know. MSCI, did you say that?
I mean, the MSCI is in the end just the index provider, so that's where the name comes from. And the Swiss market is based, I mean, what we see here on the graph is the underlying SMI, the Swiss market index. For sure, when it's about the US, you could consider the S&P index as a comparison, showing you a similar number. So MSCI is just the index provider we use here. But in general, it's the main underlying market that gets to these numbers.
And actually, MECI stands for Morgan Stanley Capital International, which is the index provider of one of the largest banks or brokers, actually. Maybe one thing to add here, you see the pretty decent performance of the US markets year to date. What we should keep in mind is that especially during last years, the US technology space was a key contributor in performance to the US market. Just to give you an example, for this year, right now, US technology is quite in focus. So I have some figures showing the some data for the S&P 500. So while the S&P 500, so the largest US market index, is actually showing a pretty decent performance or a total return year to date. If you would exclude the technology space out of that, the S&P 500 would be around -5%. So you see that the tech space is clearly the contributor, especially currently, and maybe changing or differentiating the picture on how the US markets do actually perform overall, right? Heading to the next slide, actually we switching over to Germany, showing you the second interesting country over here in Europe. I mean, COVID was quite an economic shock, I would say. What we see here is the business climate and expectation from ZDW, one of the main German research providers. What we see here, or basically the key message is that while we have seen a harsh drop throughout the year, thanks to COVID, we also saw a pretty fast recovery, especially with the business climate and also the situations of the current situation, and also the forward-looking expectation. So in other words, there is no fear of a prolonged correction. So it was really a sharp dip and showing nice recovery so far. The next slide is underlining this view. We have measured the truck tolls for kilometers traveled. A little detail which is relevant to understand the chart. When you have a truck and you want to use highways over here in Europe, especially in Germany, you actually have to pay for it. So we have a pretty nice data set showing the index for the truck toll. What we see here is that for obvious reasons, traffic went down quite sharply throughout the year, but we also are at pre-crisis levels already, which is underlining our view that the economic impact was more of a temporary one. And the next slide is showing the short-time working structure over here in Europe. Governments were pretty fast in establishing these short-time working permits, actually to avoid a massive rise in unemployment rates, and also to allow companies to stick on to their staff without rehiring them later, which would cause hiring costs and training costs until they would be really proficient in their job. This chart actually shows that for August, there was the expectation to see 40 million people being in short-time working, but the reality was by far not as bad as expected. So while 40 million were the expectation, the next chart shows that we are rather at 28 million. Still not a small number, that's a given, but it was definitely not as bad as expected. So actually our bottom line here is that the economic stabilization, economic growth is intact and yeah, basically on full steam.
Maybe a quick explanation here for the audience about the Kurzarbeit tool or the short-term working measure. So in a lot of European countries, there's that tool where employers basically can send home their employees with, it depends on what country, but between 50, 60, 70% of their normal salary or compensation, and they get paid during the time they're not spending working in the factory or in the plants or in the office, and the state is basically subsidizing that payment, which allows the employers to bring back the employees after that short period of time right into work, and they don't have that high likelihood of losing employees during that time frame because they have to let them go, like what from time to time happened here in the US.
Yeah, actually, this measure obviously works since companies were able to return to normal operation more or less relatively fast. So it was not just a socialistic idea; it was something which has proved its ability to support overall. Coming from the economic recovery or economic growth towards market valuations, which is typically one of the key reasons why people currently try or excuse why not to invest into stock markets. What we see here in the darker part is the current valuation. We took the cyclically adjusted price earnings ratio, and comparing this with the lighter version, which is the long-term PE. What we see here is a pretty clear message. The US markets, next to Switzerland, to be fair, were always valued on a higher level compared to other markets. But comparing the current valuation, we see a huge jump, especially in the valuation of US markets. So also from a valuation perspective, it could make sense to at least implicitly taking profits from a relatively rich US market and considering in reinvesting in international markets, especially in Europe and Switzerland. To be fair, Swiss valuations went up a bit as well. The explanation here is relatively pragmatic. The Swiss market is next to the US market, the second safe haven environment, both from a stock market perspective, but also from the currencies perspective. When you recall the chart we've shown earlier showing the currency performance, what we have hidden so far is that when you would have invested your US dollar cash in Swiss franc cash, not buying any stock, just the currency impact, throughout the last 40 years, you would have made massive gains, basically without risk. Our key message here is that the devaluation of US dollar in the long run will rather continue, right? So this explains why the Swiss market is also a bit higher in valuation, since people are looking for a safe haven and a stable market. And in contrast to that, Europe is relatively steady or stable with regard to their valuations. And clearly remarkable is the valuation of the UK. So right now, this market is trading at a discount compared to its own long-term value. Obviously, because of Brexit, since recent news is rather pointing towards a hard Brexit. So like Christian mentioned, you should look precisely where to invest in within the UK, since the outcome, the bottom line, is still connected with a huge question mark, right? So right now, UK markets are trading around 18% discount to the European markets, which actually speaking a clear language on this. The next slide shows my absolutely preferred chart. We have measured the fund flows, so actually the amount of dollar flowing into a fund since investors are buying, or flowing out of a fund when investors are selling. And we have analyzed ETFs covering European markets, so the iShares Europe ETFs and on all these peers. And we have looked at US registered ETFs. So basically ETFs in the international investors or US investors are looking at, and we have compared them with domestic ETFs we have over here, which are not available for you as a US investor. The interesting or the clear message here is actually the red line is showing the flows of US listed ETFs, showing clearly that US investors are have massively sold out of Europe, while I would say the insiders, the European investors, are rather sticking to their markets. Typically, we see this as a sort of early indicator, and we already see, especially recently, that US investors are returning to Europe for different reasons, be it the cheaper valuation, be it the currency situation, to implicitly take profit from the US dollar, taking benefit from a cheaper euro, and of course by benefiting from the more international diversification of European companies. So since the US market are more or less domestically focused, European markets are actually internationally focused, and right now with earnings rising again globally, this is a clear positive effect for European markets or international markets in general. The last chart actually shows the comparison of cyclical companies with their PMIs. And so we see a very close correlation between these two lines. And the bottom line actually is purchasing manager indices are all showing to the upside again, continuing their recovery, and hence we do see a further growth, especially in cyclical companies. This is actually a quick run through our positive view on international markets. Joe?
Thank you. Thanks, Marcel. So this brings us to the end of our slides, and I just want to thank you guys for taking the time today. And before we wrap up, maybe want to ask you if you have a couple of recent developments you see with your clients in regards to that market development. We learned that US investors are kind of or they sold out of some of the European investments. There might be a pushback for that. We see that some investments are undervalued in the UK specifically, but it seems like that you want to be really smart in what you invest in the UK. Any comments you guys want to share with the group here, the audience, before we wrap up? Christian?
Yes, I mean, over the last couple of weeks or since the start of COVID-19, we definitely have seen an uptick in clients who want to work with us because of all the uncertainties we also discussed today. And this is to an extent that it's a combination of reasons. I mean, it's really the investment expertise we bring to the table, but it's also having money in a different jurisdiction, depending on what outcome we can expect from the US elections in a couple of weeks. We think this trend will continue, but for most of the clients who joined us, it's really a long-term strategic decision, because The US has been a very home biased market. I mean, investors in the US are very home biased. I mean, that's in every country in general, but it's really still a very small fraction of US investors that have exposure to international markets. And for that reason, we see this trend continuing for obvious reasons of uncertainty, but also of changes in global trade in the world, how the world is changing. So from that point of view, yeah, from a business perspective, it's good times for us. And Marcel can maybe also say something, yeah, what investors did during this crisis. I mean, existing clients who had all in account in place with us, how did they further diversify?
Well, actually, we saw several clear trends throughout the year, and especially throughout the crisis. On one hand, our clients took advantage of the possibility to buy physical gold over here. So they benefited from gold price developments. When looking at stock market trends, clients shifted their investments over from US names into European markets. So basically, they kept their technology space, US tech, as a proxy for US markets, but then decided to increase or introduce international investments to their portfolio to have a more global context within. So we saw a huge and growing interest, especially in Swiss equities, for the safe haven effect and for benefiting from a currency, and also inflows into European equities to start getting their account prepared for an uptick in international growth. So these were the three big trends, I would say, we have seen during the past.
Great. Jakob, do you want to add something here?
I actually said, I mean, I pretty much saw the same, very similar trends as my colleagues due to the uncertainty in the US before the election, the COVID. We had a lot of requests and demands to look into our options to have custody in Switzerland through UBS SFA together with Marcel and Christian.
Yeah, and I can just echo what you guys said. Same development here, actually, outside of capital markets, also in the private equity space. There's more interest in. There's a clear push for maybe making a good deal in investment in Europe and specifically in the UK with the current situation where enterprise values are under pressure. So it's even a little bit wider, has a little bit wider implication than in the past. So thank you guys for joining. Thanks for the audience for making time for us and listening to us this morning or the afternoon in Europe. Please stay tuned for further communication. We are gonna have another webinar later this year focusing on emerging markets, so maybe more for the sophisticated investors. And looking forward to have this group together again. And thanks again, gentlemen, and you enjoy the rest of your day.
Thank you. Likewise.
Thank you. Bye-bye.
Thank you. Ja, das war's. Okay.